In June 2025, the U.S. Senate passed the Genius Act by a vote of 68-30. This legislation represents far more than simple regulation. It marks the evolution of dollar hegemony, established 80 years ago at Bretton Woods, into the digital age. Today, we're going to talk about the ongoing digital currency revolution. The stablecoin market has now exceeded $200 billion. Tether alone commands $143 billion, equivalent to the GDP of many nations. In 2024, stablecoin transaction volume reached $27.6 trillion, surpassing the combined transaction volumes of Visa and MasterCard. But this isn't merely technological innovation. This is the evolution of American dollar hegemony, established at Bretton Woods in 1944, taking a new form. Today, we'll explore that historical context and the monetary revolution currently unfolding. 1944 Bretton Woods déjà vu. Let's travel back 80 years. In July 1944, 730 delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. With World War II still raging, they met to design the post-war international economic order. The world desperately wanted to escape the nightmares of the 1930s Great Depression and protectionism. Competitive devaluations, trade wars, and economic blocs had ultimately led to World War. This conference began with that sobering reflection. The core of the Bretton Woods system was elegantly simple: fix gold at $35 per ounce and peg all currencies to the dollar. But behind this simple agreement lay America's overwhelming economic dominance. The United States controlled 2/3 of the world's gold reserves. John Maynard Keynes proposed Bancor, a new international reserve currency, but Harry Dexter White's dollar-centric system prevailed. This wasn't merely an economic agreement, it was the beginning of a new hegemonic order. The Bretton Woods system lasted 27 years until Nixon's shock in 1971 officially ended it. But even after the system collapsed, the dollar's status didn't waver. If anything, it became more entrenched. The benefits this exorbitant privilege brought to America were beyond imagination. While other countries traded in dollars and built dollar reserves, the United States could settle everything in its own currency, what economists call the exorbitant privilege. The rise of Tether and Circle, when private companies issued dollars. Now let's examine 2024. Remarkably, we're living in an era where private companies effectively issue dollars. Tether, USDT, launched in 2014, has grown to $143 billion. Half the size of Singapore's GDP. More remarkable is its growth trajectory, from $10 million in January 2017 to $2.8 billion in September 2018, and now $143 billion, exponential growth. Circle's USDC ranks second at $58 billion, growing 79% in 2024 alone, chasing Tether. Notably, it became the first licensed stablecoin issuer under Europe's MiCA regulation, building a regulatory-friendly image. But are these simply cryptocurrency companies? No. They're effectively new forms of central banks issuing digital dollars. Consider their backing assets. In 2024, stablecoin issuers purchased $40 billion in U.S. Treasury securities, comparable to America's largest money market funds. Tether alone wields significant influence in the Treasury market. Usage volumes are staggering. In the 12 months to May 2024, $2.5 trillion in stablecoin payments were settled, 10x growth since June 2020. With PayPal's annual volume at $1.5 trillion, this puts the scale in perspective. More importantly, consider the geopolitical implications. In countries like Argentina, Nigeria, and Turkey, stablecoins are preferred over local currencies. Digital dollarization. Tether's January 2025 announcement of relocating headquarters to El Salvador is significant. The country that adopted Bitcoin as legal tender now aims to become a stablecoin hub. Most remarkably, all this occurs without direct U.S. government control. Private companies are expanding dollar influence globally. New financial order. Traditional banks versus stablecoin issuers. We're in a transitional period where traditional and digital financial systems compete. Traditional banks operate on fractional reserve banking, taking deposits and making loans. Stablecoin issuers operate full reserve systems. Every dollar received is backed by a dollar's worth of safe assets. This represents fundamentally different business models. While traditional banks profit from interest rate spreads, stablecoin issuers earn from reserve management. Tether's $3 billion Q4 2023 profit demonstrates this. More significant changes occur in international remittances and payments. Traditional SWIFT systems are complex, expensive, and slow. Sending money from Africa to Europe requires multiple intermediary banks, with fees reaching 5 to 10%. Stablecoins enable 24/7 near-free instant transfers. Kenyan farmer receiving USDC payment from a US importer can withdraw cash at local banks within minutes. This efficiency drives rapid stablecoin adoption globally. Latin America, Africa, and Southeast Asia use them for remittances. Turkey and Argentina use them to hedge inflation. Central banks are responding. Currently, 134 countries research CBDCs, central bank digital currencies, with 44 running pilot programs. China's digital yuan, ECNY, already has 180 million wallets created, with 2024 transaction volume reaching 7 trillion yuan, $986 billion. But America chose differently. In January 2025, President Trump signed an executive order banning CBDC development, instead strengthening dollar hegemony through stablecoins. This may be brilliantly strategic. CBDCs require direct government management, while stablecoins let private companies innovate while naturally spreading dollar usage. Future prospects and risks. Digital Bretton Woods sustainability. Is the new Bretton Woods system created by stablecoins sustainable? Consider positive factors first. America maintains overwhelming dominance, with the dollar comprising 49.2% of global foreign exchange transactions. Stablecoins strengthen this position. Anyone with a smartphone can now use dollars globally. The Genius Act clarifies regulatory frameworks. Stablecoin issuers must maintain 100% backing with high-quality assets and publish monthly audit reports. This increases trust and attracts more users. But risks exist. First, geopolitical challenges. BRICS nations develop alternative payment systems to the dollar, while China's digital yuan spreads across Belt and Road countries. Second, technical risks. Blockchain-based stablecoins remain vulnerable to hacking or technical failures. The 2022 Terra USD collapse caused $60 billion in losses. Third, regulatory risks. Countries launching their own CBDCs might restrict stablecoin usage. Europe's MiCA regulation and China's cryptocurrency bans exemplify this. Paradoxically, the biggest challenge may be success itself. If stablecoins grow too large, they could threaten financial stability. Tether alone represents $143 billion. What happens if sudden redemption demands emerge? Yet history shows reserve currency status doesn't change easily. The transition from British pound to US dollar took decades. Stablecoins don't threaten dollar hegemony, they're evolving it for the digital age. Conclusion and lessons. Dollar hegemony, established 80 years ago at Bretton Woods, is evolving into new forms. Private companies, not governments, now issue digital dollars, while billions use smartphones to access dollar-based systems. This transcends technological innovation. It raises fundamental questions about money's nature, national sovereignty, and global hegemony. Private companies like Tether and Circle effectively function as central banks. China counters with digital yuan, and America chose stablecoins over CBDCs. This represents our emerging digital Bretton Woods system. Just as 1944's Bretton Woods determined post-war international order, today's stablecoin revolution may shape global financial order for decades. We stand at history's turning point.